Hi, everyone. Alan Mittleman here from Secure Digital Markets, or SDM, as we're better known in Canada. My background, I spent 25 years on Wall Street trading fixed income derivatives and running various fixed income trading groups. I joined SDM about 4 years ago now. I'm the chief operating officer for our global companies, but I'm also head of the US and head of our global derivative trading. SDM is a full service OTC digital asset dealer focusing on spot trading, lending, borrowing, and staking for our institutional clients, including high net worth individuals. We work very closely with our clients, including DATs, helping them maximize their portfolio. So most treasury portfolio holders that we speak to don't necessarily have a plan in action. They go in, they buy their assets, may or may not be the most efficient way to purchase them. And then from there, they don't know what to do with them, right? Obviously, Bitcoin natively doesn't generate any yield. You can't stake Bitcoin, for example. So this session is about building that plan before you actually need it. The current macro environment also makes this a little more difficult. There's obviously been a lot of volatility in the marketplace, especially with crypto. There's a lot of correlation shocks out there. Bitcoin has been trading with a risk-off sentiment. Interest rates are still elevated and are actually been heading higher over the last several weeks. And there's also regulatory scrutiny out there also. And the problems exist regardless of the scale of the fund of the treasury. You could have a $1 million treasury or a $500 million one or a $5 billion one. You have the same problems, right? As I mentioned before, there's no inherent yield from owning Bitcoin. Drawdown risk, if significant enough, is existential to the treasury. Treasuries need to maximize the returns on their portfolio, both in terms of growth, but as well as in terms of income. And the boards, they demand a high risk management framework. And, boards, auditors, lenders, they all asking the same questions. What is your strategy to earn yield or returns on your holdings? Do you have any drawdown policy? If so, is it documented? Have you stress tested your portfolio against some highly volatile historical periods? Have you thought about any tax implications? And what's the plan for Bitcoin sitting on your balance sheet in general? So before I get into some of the actual plans and tools that we use, let's talk about just volatility in general. Bitcoin volatility has been much higher than, say, equities since its inception. This chart here depicts the DVOL index, which is the derivative implied volatility index for Bitcoin, versus the VIX, which is the S&P 500 implied volatility index. And you can see that the Bitcoin volatility index trades anywhere from 3 to 5 times higher than the S&P. Just tells you that Bitcoin, while it's becoming a more mature asset class, it's still a very highly volatile product. And you can see here some of the big drawdowns that have happened over the last 15 years or so. We're not talking like an equity drawdown of 10 or 20%. We're talking, 30 to 70 to even 90% over the course of a year or more. So volatility isn't necessarily a threat to managing a treasury portfolio, but unmanaged volatility is, right? I think the risk managers who understand volatility and can use it to their benefit are the ones that will generate outsized returns and protect their portfolio in a more measured way. So the first thing that treasurers need to do is, what is your goal, right? Is your goal to obtain yield? Is your goal to hedge and protect against the downside? Or is your goal to use, derivatives or options for leverage exposure? And the reality is you can kind of pick and choose and use different combinations, which we'll get into in a second. Some of the, toolkits, if you will, by using derivatives or lending or as follows. And I'll get into some of them later on in the presentation. But, the basic one that is a very popular strategy is using covered calls. Covered calls is when you sell an out of the money call option and you collect premium or yield from doing so. The upside is that yield or premium that you're collecting is yours no matter what happens. The downside is you're giving up some opportunity cost, excuse me, if the market rallies past the strike price. And I'll go over an example in a minute there. The other one, if you're looking to protect against downside, you can buy what's called a protective put. You're basically buying a put option with a strike price slightly below the current spot price, and you'll be fully protected against any downside moves past that price. The downside is it costs money to do so. So sometimes what we do, we can cheapen up the protective put, which is known with a put spread, where you're buying one put and you're selling a slightly farther out of the money put against it. So that can cheapen up your protection quite a bit. The next one's a collar. A collar is a combination of both a covered call and a protective put. So effectively, it enables you to buy a put, i.e. downside protection, but you're also cheapening it up a lot by selling an out of the money call against it. So it kind of keeps your payoff profile within a band. You could also use a NDF or a non-deliverable future to actually lock in your price fully, which is great in terms of highly volatile periods. And if the board is worried about downside price action, the downside is you're giving up all upside by using an NDF. And then finally, we could do some lending and borrowing as well. That'll create liquidity, and potentially you could even just lend your holdings and earn some yield. And we'll talk about each of these in a bit here. So in terms of earning yield, let's start with the covered call. So a covered call, like I mentioned, is you're selling a out of the money call option to collect premium up front. And just as a reminder for the viewers out there, a call option in general, if you own a call option or long a call option, that gives you the right, but not the obligation to buy an asset at some point down the road at a predetermined price today. So that's when you're buying an option. What we're doing is, or I'm recommending, is selling that option. This way, you're the one that's actually collecting the premium against your holdings. So in this example, current spot is $70,000, and we're selling 100,000 strike call against it. So basically, you're able to participate in the market rally from 70,000 up to 100, but you're capping yourself up at 100,000. That's positive A. B is you'll get $10,000 or a premium for doing so. So by giving up unlimited upside, you're collecting that premium. So this is a very popular strategy to earn yield and return. To kind of walk through it a little more detail here. So kind of a base case scenario, you're selling, like I said, you go back, you're selling the 100,000 strike call, Bitcoin's trading at 70,000. You keep all that market appreciation up until 100, and you're collecting $10,000 no matter what happens. The alternative case is Bitcoin rallies past 100,000. Just say it rallies to 105. Okay, well, your entire portfolio, you're capped at the 100,000 gain. So you can still make the $30,000, right, from 70 to 100, plus you're getting $10,000 on top of that. So 40,000. So your gain on one Bitcoin is 40,000. Now, what happens after 100 if we're there at expiry, so if we're at 105? Well, there's three ways that you can settle options. Choice one is physical delivery, where that means that you'll actually physically deliver one Bitcoin option at the and collect, right, USDC or USD at the strike price. So if we finished at 105, you would be selling one Bitcoin and collecting $100,000 for it, plus the 10,000 that you received already in premium. The other way to settle it is called cash settlement, which basically means you'll settle up the dollar difference that the option finishes in the money. So in this example, if we finish at 105, if you do cash settlement in, say, USDC, you'll pay $5,000 of USDC just to settle that option. And then the token settlement or token cash settlement, you would actually effectively sell a tiny amount of your Bitcoin, almost 5%, to settle that option. So basically, we sell a small amount of Bitcoin to settle that $5,000 difference. So those are the three ways to settle your options. But regardless, you're collecting that $10,000 premium, and in a rally scenario, you're also participating in the price appreciation as well. Now, instead of like focusing on collecting yield, if you want to hedge and protect the downside, what can you do? Well, I mentioned earlier, you can buy a put. And in this example here, with spot at 70,000, we're buying a 55,000 strike put, and it's costing $10,000 to do so. So what's the risk and what's the return? Well, your risk is only $10,000. You can never lose more than that from the premium. Additionally, because you're buying the $55,000 strike option, you will, if the market goes down, you'll participate in the losses from 70,000 down to 55. But then that's floored. You can never lose any more money. So if the market, say, went down to 25,000, you would be protecting yourself from 55 all the way down to 25. So your net loss then would only be from 70 to 55, and plus the premium that you pay. And obviously, with selling calls or buying puts, you can change the strikes however you see fit. For example, you can even choose a 70,000 strike put option where you're guaranteed not to lose any money other than the premium paid. Except the premium, obviously, that you're paying is going to be a little bit more money than 10,000 if you're selling if you're buying the 55,000 puts at 10,000. Another popular strategy, we'll go back to this here, is called a collar. And a collar is basically a combination of both selling a call option and buying a put option. And I mentioned those earlier, but we can do these for a zero cost. So what does this do for you? Well, it still will give you some market price appreciation potential on the upside. Plus, it'll also protect you on the downside in the event of a significant downturn in the market. So in this example, spots at 70, we sold 100,000 strike call. We bought a 55,000 strike put. So we're basically going to be locked in at expiry anywhere between 55 to 100. And you can see this on the graph right here. So we're going to participate in price appreciation up to 100. We'll also participate in price depreciation to 55. But anything south of 55, we don't lose anything. And anything north of 100, we don't gain anything. But the benefit of that structure is that it doesn't cost anything to do. So this is called a zero cost collar. And it's a very prudent strategy where this way you can still participate in the upside, but limit your downside. Exposure on, once you have exposure to Bitcoin, the covered call, protective put, collars, etc., could be very good trades to do as part of your portfolio. However, what we didn't talk about yet is when you're accumulating your assets, are there better ways to accumulate your assets than just going into the market and buying it all on day one? And I would argue yes. And there's typically three ways to accumulate other than buying it all on day one. And I think they're all can be part of a prudent accumulation strategy. One is called the TWAP, or time-weighted averaging program, where basically you're buying assets or Bitcoin over the course of a certain time. Could be over days, weeks, months. You predetermine it, and you're basically buying an average price over the time. Now, this is good because no one's ever going to consistently pick the low price to buy. And, people hopefully aren't going to always pick the highest price to buy, which would be bad. So by doing a dollar cost averaging, it's a very prudent strategy to get a weighted average price over a certain time frame. The other thing you could do, one other thing you do is sell puts. And when you sell puts, like I mentioned, you could actually collect premium on the sale of puts. And if the market finishes at or below your strike price, you can exercise those puts, meaning you'll buy Bitcoin at a discount to current spot. So if you go back to the example, if Bitcoin's trading at 70 and just say you sold the 65,000 strike puts, well, A, you're getting a premium for those puts up front, which is yours no matter what, which will lower your cost basis. And B, if the market does go lower than 65, you'll be buying Bitcoin at $65,000. So it's a good way to potentially generate some alpha as a portfolio is just starting to grow. And then the third way to potentially accumulate is called a Bitcoin accumulator strategy, which I'll get into here in a second here. Basically, the way the accumulator works is, and I'm not going to get into all the details, but it's a structured product that enables the buyer of the product to purchase Bitcoin at a roughly 10% discount to current spot. So there are obviously some bells and whistles in here, such as like a knockout option, and don't want to confuse the viewer, but it's a great way to put some of your asset purchases into this product, knowing that you're going to be buying something at a discount to spot. Unless the market just rips higher immediately, then the trade would end and there's no harm. But this product doesn't cost anything to get into, zero cost, zero upfront, and enables you to buy Bitcoin at a significant discount to current spot. So typically we recommend some type of combination of TWAP and or selling puts or the accumulator strategy while you're accumulating your Bitcoin treasury. The other things people can do with their treasury portfolio to either A, earn return, or B, generate liquidity is to either lend or borrow against your crypto. And the reason we recommend this instead of maybe some other alternatives is A, if Bitcoin is down, say Bitcoin's down in price from when you bought it originally, and you need liquidity, well, you're forced to sell. So you're basically locking in a realized loss permanently, and you'll never get that back if you sold your Bitcoin. The other thing, if Bitcoin is up since you bought it and you need to sell to generate cash, what are you doing? Well, you're kind of crystallizing your gains, hence most likely forced to pay taxes on those gains. So lending and borrowing consists of two things. You can either A, take your Bitcoin that you own. You could take your Bitcoin that you own and just lend it out outright to the market and earn roughly 5% on that crypto holdings. Or B, what you can do if you actually need liquidity, you can do a Bitcoin backed loan, where effectively is you'll be taking in fiat or stable coins and lending out your Bitcoin as collateral. And when you lend it out as collateral, typically the going market loan to value is roughly 65%. You'll be paying, call it high single digits on the cash, but it'll free up liquidity without forcing you to either sell your Bitcoin in an up market or a down market. Now, obviously, when you're doing lending and borrowing, you might have you have risk of a potential margin call. So if you borrow dollars and lend out your Bitcoin against it, and the market goes down more than say 30%, you might get a margin call. So if you get a margin call, there are multiple ways to meet that margin call. One is you can return some of the loan that you took out. Two is you could post additional collateral. And then three, most of the loans that we do are non-recourse loans. You could actually just walk away from the loan and no one will ever come after you. So if, for example, if Bitcoin was at 100,000 and you borrowed against it and Bitcoin went down 90% immediately, you could just walk away, keep your cash, and at least you'll have your cash in hand and don't have to worry about it. There are ways to also solve for a margin call. And, one of them is combining the derivatives with the loan. For example, you can buy a put or a put spread on some of your Bitcoin holdings that you lent out as collateral and use that derivative or the put option to help protect you against any potential margin call. Now, in this last module here, I'm just going to give an example of kind of putting it all together in terms of combining some of our derivative trade ideas and strategies with lending. And one of the most popular ones are when you're borrowing fiat and posting your Bitcoin as collateral, you could then pair that with selling a deep out of the money covered call against that, take the premium that you're earning from selling the covered call and use that premium to pay interest on your loan. And we could structure that in a way where you can do and ultimately be left with a zero cost loan on your books. And let me just walk through an example on that. So in this example, client has $10 million, takes out a loan for $10 million, I should say. It's a 2-year loan, interest rate of 7%. So the cost over 2 years would be $1.4 million, right? Or $700,000 a year. Now he can sell a 2-year covered call deep out of the money and generate premium of 14%, or same $1.4 million that he would then use to pay the interest on the loan. And we would structure this all as one trade or one structured product. So effectively, the client would have an interest-free loan for the next 2 years. And the only, I'll say, potential risk is A, if the market goes down a lot, might get a margin call. And B, if the market rallies past the strike price on the call option, then the upside on this Bitcoin will be capped at that price. But this is a very popular strategy, especially for people in need of short-term loans and don't want to pay the interest on it. I often get asked a lot, why trade over the counter, right? Why trade with SDM? Why don't I just go to an exchange, for example? Multiple reasons. One, besides SDM providing white glove service and working closely with clients and providing guidance, and OTC derivatives, they're very customized, right? We can create any bespoke transaction that you'd like. We can do it on multiple assets. We can change the sizes, the expiry dates, how the premiums are paid, you name it. On the exchanges, there's certain expiry dates, for example, end of month or the last Friday of the month is when the most popular ones are. Well, you might want an option that expires in 3 months and 1 week, for example, because I don't know, maybe you have a lockup or something expiring and you want to match it perfectly. We can do that. The other reason is privacy, right? Obviously, on exchanges, everything can get publicly disclosed. When it's bilateral, you're just dealing with SDM, so everything is kept private and confidential. Also, too, when you're posting tokens, at an exchange, you're forced to post whatever they need. Could be cash, it could be stable coins, or potentially it could be the underlying coin. But sometimes people want to say post as margin the underlying coin, but they want the premium, especially if they're selling a call option, to be paid in USDC. We can do that. And obviously we're open, 7 days a week, 24/7. So people can come to us anytime, and we'll be able to put prices on things and work with you to accomplish what you're trying to accomplish. So in summary, what I would say is, reach out to us, reach out to SDM. We're happy to provide, obviously, a no-cost treasury risk review. We can talk to you about your current portfolio, or if you're thinking about accumulating various assets, we're happy to work with you, with our team, to put together a strategy in place to maximize your returns on your portfolio, limit your risk, and accumulate assets in a very smart way.